What's going on, everybody? It's been a while since we've done these live Q&As, but basically there's going to be an area where you can ask some questions. And if you guys want to ask any questions about fundamentals, economics, technical analysis, and psychology, now's the time to do so. I'll probably be running this for, I don't know, 30 minutes, 1 hour. Yeah, now's the time. Make sure you guys stay hydrated. Oh shit. So don't ask your questions in the comments, otherwise I'm not going to be able to see them because the comments go by pretty quickly. There should be some button on your screen where you can submit a question. You know what I mean? So if you guys are spamming questions in the comments right now, it's going to be difficult for me to read and see it. I would advise you can click a question mark somewhere on your screen or some shit like that. First question. Classic.Gardner. Ayo, buy gold or sell gold right now? Well, if you want my in-depth analysis and expectations on gold and trade ideas, I'm currently uploading a market analysis webinar to YouTube, which will be available at 8:30, or it's already uploaded to Twitter because for some reason it uploads faster to Twitter. But anyways, more than likely, gold is going to remain in the secondary phase of market structure, which is a consolidation, or if you prefer to call it an accumulation. We can see that gold is still in intraday bearish market structure with the market focus on rates being up higher for longer. But as we're starting out this new business quarter and have a lack of fundamental events, we're just seeing a period of indecision and ranging from about 1905 to about 1930. So more than likely, we're going to remain in that range up until CPI, where that would be the kicker. Just for some quick reference points, if we get any new fear, uncertainty, or doubt, a collection of bad economic data, or anything else to bring demand into gold and appeal to its safe haven side, I would see pretty safe, clean buys above 1935, going up to higher time frame ranges of the 1960s. Otherwise, below those prices, I'm still bearish for the time being. Underscore C Luca. Best free site for Forex news, the Capital Hungry Twitter. Forex Factory, the Unusual Whales, if you guys know them on Twitter, and their news site. A bunch of these news websites all follow Capital Hungry and source headlines from Capital Hungry once in a while. So we're always posting headlines, always posting news, economic data, information, and everything in between. Let's just keep ripping through these. HappyCon5686. Is there any videos of yours which help us to learn about fundamental and technical things? First, my first piece of advice for you, sir, is go back to grade 2, learn how to spell. After that, then once you learn how to spell, go to the Capital Hungry YouTube, and then you'll be able to better read the video titles. Once you go to the Capital Hungry YouTube, you're going to see that there's over 400 free videos. There's playlists, fundamentals, psychology, technicals. But right now, you probably can't read the titles because you don't know how to spell. So first you have to go learn how to read, write, and spell. Then come to the Capital Hungry YouTube and you can learn how to trade. I don't know how to say your name, so I don't want to try to butcher your name and be disrespectful. How can I join your private group? That is just through the website capitalhungry.com. If you are a new trader who doesn't understand basics of like what pips are or how to do basic charting analysis, then don't join the Capital Hungry private channel. Capital Hungry private channel is for intermediate to more advanced traders who want to bring together real world economic psychology and fundamentals to have a better image of what's driving market price and why, and how to stay adaptive to different changing market conditions. But the 100 webinars on Capital Hungry in the private channel are very long. They're very intensive. There's a lot of work involved, a lot of study. If you're not up to that, I advise you don't join Capital Hungry. It's going to be way too much work for you. Mr_I'm_Varma. GJ weekly retracement possible? Yes. I do think that we're currently seeing GJ in a pullback structure, and I've uploaded some analysis for free on YouTube, which will be available at 8:30 p.m. Eastern, an hour and a half from now, and on Twitter, it's already available. Right now, we're seeing the Japanese yen to start out this new business quarter just pulling back from intraday lows and setting up prices. So we have short-term strength in the yen, as well as less demand in the British pound and in the US dollar. The only thing you have to look out for, is UK labor market data tonight. Over London session tonight, we have UK employment data, the equivalent of what we see on US NFP days. Your employment change, your unemployment rate, and of course your unemployment count and these other job counts and information that they release. If the UK labor market data is still healthy and optimistic, that's going to lead to a bounce in GBP, and you're going to see more demand in the British pound because the markets are also going to price in the Bank of England keeping interest rates up higher for longer and continuing to tighten financial conditions. So yes, a GJ pullback is possible. I'm looking to see that we could still retest maybe even into like 180 flat area, I think I was last looking at. But otherwise, the main focus point for GBP JPY in the near term is the labor market data tonight. There is a possibility, an increased probability, that labor market data can be rebounding better than the prior reports, still following signals from the Bank of England and leading to some demand in the British pound. Are you expecting stronger than expected wage inflation reading for GBP, with Bank of England wanting to continue to bring inflation down? Now, the Bank of England is going to be sticking to their projections of bringing inflation down until it hits their targets. But as they've been front-loading rate hikes, and obviously that works its way through the economy and trickles from the top all the way down, we're going to start to see UK inflation trending down, starting to correct a lot of the abnormal price changes that we saw during the 2021 and 2022 period. So UK inflation is going to be following suit with US inflation as the Bank of England front-loaded rate hikes and will be keeping rates up higher for longer. So it will be trending down. The main focus point is once UK or US inflation gets to baseline again, around 2-3%, that's where you really start to see the struggle of maintaining prices at that point. So it's still going to be a difficult path, and inflation is still going to remain sticky as we start to approach that 2-3% threshold, and we still have all of these uncertainties lingering for maintaining inflation there for an extended period of time. But more than likely, UK CPI starting to show signs of trending down. Bank of England is still going to keep rates up and still going to keep policy in a restrictive stance. Eric_Paulius, big fan of what you do. Thanks, appreciate it. Does your Twitter supply enough info to understand fundamental analysis? The Twitter isn't really going to be teaching you foundational concepts to understand what's going on and why. The Twitter is reactive live news headlines, economic data releases, me sharing updates of what I expect for data, predictions, and so forth. If you want to learn the foundational concepts first, so you can start building off of that and understanding fundamentals on your own, I would advise going to the Capital Hungry YouTube page and going through the Educationals webinar playlist. If you want to get even more in-depth in that and want to invest in yourself, you can join the Capital Hungry private channel. Why? This is a good question from Rafa. I don't want to butcher this last part, but this is a good question by you. Why is the market greedy if the Fed is still being restrictive? Do you think the market will be bullish anytime soon? Now, when the example of stock markets, I've been primarily looking at the index US 30, Dow Jones. From a technical standpoint and understanding key price points, I can't confirm that US 30 is in a new bull market unless we're having the markets price in expected near-term rate cuts and we're trading above price point 34,500. Otherwise, the US 30 example, we've just been moving sideways ever since the start of 2023 because of understanding human nature and how strong market greed is. So to understand the first portion of your question about market greed, we have to understand the real world implications of a bearish stock market or stock market bears for an extended period of time. It goes well beyond just our visual representation of the charts. We see the stock market being bearish as a bunch of red candles that we want to short and take advantage of in trades. But in reality, the stock market being bearish for an extended period of time, with how interconnected it is within our economy, it has a major impact on corporate profits. It has a major impact on lending and loans with banks and institutions. It has a major impact down the line on wages and job growth and everything alongside economic growth as well. So there's a lot of fight for the stock market being bearish due to those real world implications and connections to our economy, to our day-to-day life, corporate profits, bank lending, debt obligations, and so forth. It's a heavily interconnected web that's been created through this power, pursuit of power, corruption, and greed, but that's just the true reality of it, right? Now, at the end of the day, stock market corrections and bear markets are inevitable. Having periods of downside in economies such as recessions or even depressions are inevitable. It happens. It's happened before and it can happen again, right? So that is something we still have to look out for. And it's very difficult for me to see equities in a new bull market as long as interest rates remain above 5% for an extended period of time, because majority of banks and institutions are leveraged into bets that would be prosperous. The bets would make money in a lower interest rate environment. The main reason Silicon Valley Bank collapsed was because they were over leveraged in a bet on bonds that was hoping for a low interest rate environment to come back. And as rates kept going up and remaining up, because they were heavily leveraged into this bet, they could not, you go pretty much margin call and you bottom out there, and then they needed to be saved. And then you had this mini banking crisis, which can still be going on. You know what I mean? Zain.Mustafa. Any specific psychology webinar for coming back to markets after a break because of heavy loss? Now, the Capital Hungry YouTube page has tons of educational webinars. One I would suggest you to watch right away is the webinar Understanding the Psychology of Losing. Understanding Losing. So if you go to the Capital Hungry YouTube page or you search Psychology of Losing Capital Hungry on YouTube, that should come up. And I think that would be a great webinar for you to watch in your specific current situation. Harry X Photography, how to control emotions. Now, this is a question I get asked a lot. One, the first point I'm going to make is you have to understand that your emotions translate in all aspects of your life. You're not just going to be behaving one way in trading, but then behaving another way in the gym and behaving another way at work. Your emotions translate to all aspects of your life. They're just amplified in different events. Within trading, because you're putting money on the line and because you're risking something, the emotions are amplified. But it's the same emotions you deal with in your day-to-day life. If you don't have discipline, self-control, and patience in your day-to-day life, if you have a very short fuse, you get angry and stressed easy in your regular day-to-day life, those same negative emotions are going to translate into trading and be amplified times 10. Same thing with emotions of greed and excitement. If you get excited when you hit a PR in the gym and you get really, really happy, when you make some money and take a winning trade, it's going to be times 10. You're going to feel like a god. Like, holy shit, this is amazing. I'm the best. So all of your emotions within trading get amplified times 10, I would say. So the first thing is you have to create a healthy, balanced lifestyle outside of trading. Have a set routine and daily plan and schedule you follow. Learn to delay instant gratification, which means stop chasing short-term satisfaction, right? Bring discipline in your day-to-day life, like doing your chores or cooking for yourself or going to the gym or going for a jog, right? Learn to control your decisions in your day-to-day life, and it's going to be a lot easier to control the decisions you make in the market. That's my first piece of advice. Learn to control your emotions outside of trading first and bring as much structure to your life as possible. The second piece of advice is with your actual trading. This is something I've been teaching in Capital Hungry, and it may sound very simple, but it's a huge factor. You have to have events that you introduce to your trading process that intercept the irrational emotional thinking process. So what do I mean by that? Well, let's just look at your average Joe Blow retail trader. They're going to wake up for New York or London. They're going to get up and be groggy and go right on the laptop or pull out their phone. They might be watching some Netflix on the side. They're not really focused. They don't really have a trading plan. They don't have any long-term vision. They're just waking up, knowing it's London session. They want to scalp and they want to make some money. They're already at a disadvantage before they even entered a trade into the market, right? They're already at a disadvantage before they even looked at the chart, just with how they're setting themselves up to already be in an automated emotional trance, right? Everything they're doing is automated. It's on autopilot. They're not active in their decisions. But then you have trader number 2. This trader wakes up and in the morning, before he even steps on the charts, he goes through his physical trading plan again. He has his trading plan printed out and he reads it. This is the types of trades I like to take. This is my trading style. This is what I look for. Then he goes to the charts and actually scans the charts, follows his criteria, and marks out some potential setups. Then he sets alerts for these setups. He reminds himself of his risk management plan. He keeps his mind occupied and isn't just staring at the charts. He has his price alert set up. He's reading a book. He's doing some back testing. He's keeping his mind active rather than just being a mindless zombie who's pulling out his phone on the train, pulling out his phone on work on the toilet, pulling out their phone at their friend's house, and entering some random shit because they feel like they should make some money right there. So you have to have events that intercept emotional thinking. And the example that I'm giving about trader number 2, he has multiple events that help him remain objective and avoid emotional thinking. One is reviewing his trading plan. Another is doing pre-planned analysis. Another tip is setting trade alerts, setting a hard stop loss in TP, exerting and practicing patience by actually waiting for the trade setups, not just entering something because you're staring at the chart and say, oh, this looks good. This is a little bit of a support. That's a resistance. We just bounced off this fib. We're rejecting this EMA. I'm going to take something now, right? It's a completely night and day difference of how they're attacking the markets. Mr. Sana, what do you think of smart money concepts with those tight stop loss with high rewards? I think it's a bunch of bullshit, marketing, and misleading. One, whenever you see people share those trading view charts and they have a 3 pip stop loss, a 5 pip stop loss, and they show they got 100 pips, more than likely it's some bullshit. Because they're not even factoring in that when you're actively trading, something called spread exists. All of us have to deal with retail trading brokers, whether it's regulated or whether it's unregulated. How many of us remember countless times where you're in an entry and as soon as you enter, spread starts to spike a little bit. Spikes 5 pips, spikes 6 pips, tightens up again. So if somebody has a 5 pip stop loss, just a simple 2 pip drop in spread is taking that trade out. So it logically makes no sense. It's not realistic at all. What you should be trying to go for is have a stop loss that's placed on where your trade would actually be invalidated. 90% of trades need room to breathe. It might go into drawdown a little bit. It might range around your entry. It needs time for it to play out, right? People just show these trading view charts of some pinpoint wick entry, a 3 pip stop loss, and a straight 100 pip gain, but they never show the real trades. They never show any consistency with it. It's really just bullshit, marketing, misleading. It's more for ego and personal showing off rather than actually being a successful, consistent trader. My advice, if you're day trading, go for a 1 to 3 risk versus reward. On the example of day trading on gold or GJ, I generally stick to a 20 pip stop loss and a 60 to 80 pip take profit. That's very realistic, a very realistic manageable stop loss on day trading, very realistic day trading pip goals, 60 to 80 pips over a period of hours or sessions. And with a 1 to 3 risk versus reward ratio, over a stretch of 100 trades, you could lose 50 of those trades and still be very, very profitable. Right? So think about that. Sankey.pips. Great question as well. Is it wise to stay away from taking trades after an emotional life event such as a death or breakup? Yes, that is extremely wise. I have this story that I always tell people in Capital Hungry, and publicly you may have heard me say it before, but when I first started trading, I knew this older gentleman, right? He was like a Middle Eastern guy, this older gentleman, right? He had a pretty great textbook setup. I mean, he was married, he had kids, he had a house paid off, he had a good full-time career, he was consistent trading on the side, and he transitioned into full-time trading. He's trading with 6-figure accounts because he was an older gentleman. He's developed his capital over time. He became a consistent trader over years, rinsing and repeating his same methods, right? Everything went down the drain for him in his trading and in his life overall when he found out his wife was cheating on him and he went through a divorce, right? He started to get more heavily involved in alcohol, drinking a bit more, being a lot more depressed, doubting himself, and then the worst decision he made is in this state, he went back to the charts and he lost everything. So at the end of the day, unless your trading is algorithmic or automated, right? If you are a manual retail trader, the events in your day-to-day life or in your overall macro life, they're going to have 1,000% impact on your decisions. If you're feeling very down or you're having somebody harassing you and your family, right? Let's just say you have some piece of shit family members and they're making you feel very insecure or insignificant and doubting yourself. And you go into this state where you're doubting yourself and you're not feeling as confident and you're feeling like you're not worth it. If you take that same mentality and jump on the charts, like, come on, it's not going to translate well, right? So having that emotional control and what I was talking about in your day-to-day life is very important, but 100%, if you're dealing with any type of trauma or dealing with a poor emotional situation in your life outside of trading, you should not be looking to jump on the charts. It is not going to end well. Boomy underscore boy. What is your preferred session to trade gold? Now, over the years, I've transitioned more into day trading. I've like to see gold in a trending market, not in a consolidation, either cleanly trending more bearish or trending more bullish. I find the best day trade setups for gold really come in this period from later Asian session to pre-London hours. I like to see the new daily candle setting up and potentially giving a pullback against current trend so I can get a better position to ride trend. So usually I found that the best positioning I find when gold or GJ is trending is from my time zone about 10 p.m. Eastern after China markets open and you see this mess that comes in around 9 and right before London markets are really taken off. That time window from about 10 p.m. till about 3 a.m. It's a little bit of a large window, but I find you can get really good day trade setups during that time that you can hold through London and potentially even through New York if you have the fundamentals and sentiment still supporting your bias. Bring it 888. Can scalping be done successfully longer term, and how would you go about this? Yes, scalping can for sure be a successful method and style of trading long term, but you have to understand every single style of trading, scalping, day trading, swing trading, every single style of trading has its pros and cons. Scalping, let me give you an example. Pros of scalping. You can take trades in a very short period of time. Your trades play out in a very short period of time. You can be at the charts for a set window of 2 to 3 hours. You can take advantage of sessionary volume. Disadvantages. Smaller pip ranges you're taking advantage of. Decreased probability you're going to get a larger risk versus reward. Increased probability you're going to overtrade. Because understanding your scalping and you're taking advantage of smaller moves, it's much easier for the greed demon to creep up on your shoulder and say, take another trade, take another trade. Or when you lose a trade, go, you can win back right away. Look, the market's still moving. You can get 10 pips here, then 5 pips here. So there's pros to scalping, and it's going to be dependent on your personality, and there's cons as well. I find the trading style that can lead to over trading the most is 1000% objectively, logically speaking, scalping, right? Now let's look at something like day trading. The pros of day trading are you're taking advantage of larger moves. You're having potentially larger risk versus reward ratios you can take advantage of. You're playing more of the intraday time frames rather than the lower time frames. But the cons are there's way less day trade setups and opportunities versus scalping setups. Scalps, you could always find a scalp. The market's always moving, right? With the day trades, you want to be looking for key pre-planned areas of interest, and it may take hours, sometimes sessions, to revisit this price or reach this price you want to execute on. Another con of day trading is it takes a lot more patience. A lot more patience to wait for your entry, a lot more patience for that day trade to play out. When you're scalping, looking for 10, 20, 30 pips, that can play out with sessionary volume in a matter of minutes. When you're day trading and you're looking for 80 pips, 100, 120, you have to understand the time sensitivity, and that trade may take hours to play out, if not multiple sessions or days. So every trading style has its pros and cons. You just want to understand the ins and outs of each trading style, understand those pros and cons, and see what best fits your schedule, your personality, and your lifestyle. Push play underscore 21. Is there plenty of info on YouTube for economics and how to implement it into a trading plan? If you're just talking about on YouTube in general, like the internet, yes, there's limitless info on the internet on economics, psychology, and fundamentals. If you're talking about specifically with the capital hungry content, 100%. I have like 450 plus videos on YouTube. Who does that, right? Who is out here? Obviously, I run the Capital Hungry private channel. I also want to get paid for my time, effort, experience, and knowledge. But what other educator or social media influencer do you know out here who's doing that much for free? Newsletters, reports, analysis, predictions, IG lives, like webinars, educational stuff, everything. You know what I mean? The reason why I can do so much for free is because I am 1000% value focused and value based. I know that there's a lot more I can teach for my paid time as well, even more in depth with even more effort and content. So because I'm always learning more, because I'm always involved in the markets, because I'm actually trading and doing analysis on the markets, I always have stuff to share. Stuff to share about fundamentals, fresh analysis, technical charting, a new psychology webinar idea, answering questions. It's never going to end for me. Compared to people who are just doing lifestyle marketing, eventually you realize that this person's just flashing flashy shit and showing random shit, and they don't really have much substance or information or value or anything to really teach you, right? So the Capital Hungry YouTube, there's no lifestyle marketing. There's no random bullshit. It's just educational content. Bostwan, Jeeve, did you share your gold trade in your groups? Yes, the gold sells, if we still stayed below 1930s, was both shared in last week's YouTube webinar for free, as well as an updated intraday market analysis within the Capital Hungry private channel. We've only been looking for gold buys if we can cleanly break above that liquidity zone and have fundamental reasons to support so. Otherwise, if we're still retesting that liquidity zone and failing to break, we've still been taking shorts there on gold as we're still respecting intraday bearish structure. Underscore BPD. Any long-term opinions on crypto based on the psychology of market cycles you mentioned before? Okay, so if you guys have watched, I did this prediction on Bitcoin around a year and a half ago where I predicted the crash from 60K all the way down to 15K. The reason being that's the real first market cycle that crypto was going through as a whole. When you had the mania public pump phase in the bull trap, and then you had the sweep when the Fed started aggressively raising rates. Now, I still see further downside in crypto, but I don't see crypto going anywhere anytime soon. I see it as another investment class. I see it as it can still have room for expansion in its actual technology and use cases over the years. And I see it as a long-term investment once we hit lower prices, maybe Bitcoin doing this bull trap and sweeping back out to 15, 20K again. So long-term, I'm still more bullish on crypto, especially after this correction and crash. Just understanding it's another asset class, an investment vehicle that's not going anywhere. It's gaining some more history. It's going to get further innovated in its technology and real-world use cases. But that upside on Bitcoin and crypto that we saw during 2020, we're probably never going to see volatility like that again. In my opinion, for us to reach those Bitcoin high prices again at like 70K, that might be like a 5-year target from now, like a 3 to 5 year target. You know what I mean? So I'm still bullish on crypto long term after this crash. I can still first see some lower prices being hit again, and this currently still being a bull trap, but I'm not expecting huge mania or huge upside volatility. I'm expecting it to slowly creep up to its higher prices longer term over the next period of years. #888_Nero. How would you go about learning fundamentals? For me, I went through this period of trial and error of learning basic macroeconomics, which I already had a foundational understanding through college and schooling. But then what you learn in school, I like to call textbook economics. It's not actually information you can apply to the charts and to trading. It's more information that's going to get you a job in finance or in economics, and it's going to get you a career. Learn, like actually tracking and learning about what goes into GDP and the formula and calculations and so forth. You do want to have that foundational understanding of macroeconomics, but overall market fundamentals is having foundational knowledge. For me, that encompasses macroeconomics, understanding global geopolitical tensions and market cycles such as crisis periods, boom and bust periods, human nature, and technical analysis. For us as retail traders, where we're already at a disadvantage and the majority of people lose in retail trading, we want to have as much of an edge and as much of a increased probability in our favor as possible. So for me, market fundamentals or gaining foundational knowledge in the market encompasses all of that. It encompasses learning your macroeconomics about like data reports, what drives economic data, central banking, and so forth. Understanding real world events like geopolitical tensions and market cycles, such as periods of recession and so forth, which also falls into macroeconomics. Then understanding human nature, greed, the pursuit of power, and corruption, because the markets are 100% intertwined and driven by that as well. Your own personal psychology, risk, the mathematics of risk management, the mathematics of probabilities and thinking in probabilities, and last but not least is your technical charting and reading of price action, market structure, technical analysis. I think a good retail trader should spend time and energy learning all of that. And that's going to give you the best vision, the best understanding, the best weapons to attack this vicious market. You know what I mean? Starboy Brian, do you still smoke weed and work out in the gym? If you're talking about together, not really. I still smoke weed with friends on occasions, but not generally while I'm working or trading. I like to stay 80% productive and 20% of my time focused on pleasure. In the gym, I've just been trying to just have as intense workouts as possible. So I used to back in the day smoke fat before working out. You know what I mean? And you would for sure get in this tunnel vision mindset, but it also has an impact on your breathing, your blood flow, and your overall energy levels. So I find that it's better to work out just solo dolo. I think that's pretty much it for today. Just general questions about the markets, some fundamentals. This Boomy_boy, where do you get your news information and predictions? This. In between your ears, you have this magical supercomputer where if you get off TikTok, if you stop jerking off to porn, if you stop eating cheeseburgers and Cheetos every day, you can train this to be the most vicious, ruthless, efficient, sharp, knowledgeable tool at your disposal. Abdul Coco, hey Jeev, I want to join your private server, your private channel, but I want to ask, does it cater for beginners too? Oops, 1 second here. The hell did I click? I lost that. So, I want to ask, does your private channel cater to beginners too? The true, blunt honesty is, I could easily say, come join the private channel and take your money. But if you're a new trader, beginner, no. It's going to be way too intense for you. I highly advise you just go through like Raja Bank's course, which is a great introduction to new traders, or something like babypips.com. Like if you're really just a fresh beginner, you don't have the bare bone foundations down, like you don't know what a pip is or how to count pips, or you don't know how a Japanese candles chart works, then Capital Hungry is not the starting place for you. You want to at least have some beginner surface level knowledge, and then when you come into capital hungry, you can really dive into all the in-depth information. RS4 build. Fundamental events you're waiting for indexes. This week, main focus point is central bank speakers, which so far their comments haven't had much impact at all. The main driving factor is going to be inflation. Right now, US 30 is sitting in a range from about 33,700 lows to about those highs of 34,500. If inflation is dropping as projected, as the Feds have been front-loading rate hikes, the markets are going to take this as a reason to rally, as they're going to price in future rate cuts earlier. So we could still see this inflation report potentially trending down still, which can lead to some dollar bears and stock market bulls in the range. Nothing huge in movement in my opinion, but as we start to see CPI trend back to baseline levels, this is where inflation is going to get sticky. I don't know if you've noticed, even though inflation has been actively trending down month over month due to the Federal Reserve's front loading of rate hikes and tightening of financial conditions, the Feds themselves, including Powell and other Fed speakers, have still been pushing inflation being sticky and rates up higher for longer. The reason for this, as inflation gets back to the baseline level and you're getting to the target of 2%, the difficult job isn't getting inflation to 2%, it's getting inflation to 2% and maintaining it there back at the baseline level. That's where a lot of struggles, uncertainties, and fluctuations in inflation data comes into play. So we might start to see these increasing inflation reports or fluctuating inflation, if not this report, the next ones. If CPI is still trending lower, that's just going to have markets pricing in future rate cuts. That's going to lead to dollar bears, stock market more bulls. But if CPI is still high, it just shows that the Feds are going to keep rates up. That's dollar bulls, stock market bears. But anyways, everybody, this was a nice little live session. I'm getting pretty hungry right now. It's currently 7:30 p.m. Eastern. In exactly 1 hour from now, you're going to have a market analysis and trade ideas webinar uploaded to YouTube that you can watch on the Capital Hungry page. Or, of course, on Twitter, it's already uploaded there. All right. So, everybody, thanks for tuning in. If you guys enjoy these, I'll do these once a week. I'll do the market analysis plus the CH analysis, like Sebastian in the lab have been doing a great job. If you guys have been keeping up with the information advantage reports, economic data reports, and the short form content like the PMI breakdowns, data breakdowns, and so forth. So make sure you stay tuned to all the capital hungry content. But I think we've been going for 30 minutes right now. It's going to time out shortly anyways, right? Yeah, this is saved.